But why did I talk about this staying open before going up into this area here? Because we've traded above the consolidation. All of this right here. Let me do it like this. All this price action here. We've traded higher since 9:30. Here, up, back down, traded higher, consolidating. Okay. I don't like these kind of days, and I would rather wait for more information or do nothing, because on a day that's showing me that it's not trying to gyrate around too much, it's small and compressed. It's a lot of stagnant price action. Whereas when it does finally move here outside of that range, we had the stops below here taken out, as I mentioned, and then we traded above the high. Okay, wonderful. Once it does that, that means we left this consolidation. Did we lead the consolidation after a stop hunt? Yes. So that means once we're outside of this range, and if we have a fair value gap, those tend to be left open. So what does that mean? You can feel, not today, not on a day like this, but you're going to see me talk about it on other days where there hasn't been a big PPI number or CPI number or something to that effect, where we move outside of a range and we have this same element here. This is something you can go back and look at your old charts. Maybe it's a trade idea that you lost on, or maybe you missed a move, or maybe you didn't know what the market was going to do, and you can go back and look at your old charts and see this here, and you'll see that they stay open, not all the time, but most of the time. If it's something like this and you anticipate them staying open, and you have a target up here that you think is going to draw a price to, you can put this candlestick's low, your limit order, right at that candlestick's low, because then it only takes one tick to get below it to fill you long, and then aim for your target. Now, this is like a bread and butter type setup where it's not a whole lot of movement. It's not a whole lot of range, but you can see we did trade all the way to the top of that volume imbalance on the daily chart. The institutional order flow entry drill is more specific to when we like to see a gap stay open. So if it does get below that low and enters into it, the underlying assumption is that you think that this is going to somehow remain the lower half open. Okay, some portion of this gap between these two candles isn't going to be completely overlapped with sell side delivery. That means the market moving lower. If this is not your cup of tea and you can't see that, okay, then you would be trading order blocks. Okay, and that would be this candle right there, and that candle right there, and that candle right there, because all three of these candles are all one order block, meaning that this order block, it's not just the last down close candle before the run up. These three consecutive candles are trading back down into this gap that has already been primed to send price higher. And we're just getting one more visit here. And then it trades above it. And it comes right back down and digs into this entire range here. See that? So if you look at it like this, can you tell I'm having fun today? I was supposed to get out of here at 10:30. What time is it? It's almost noon. I had some people complaining, can you make your videos shorter? I can't watch all this. I can't help you, man. Go watch somebody else. Go learn from somebody. Go watch the 5-minute trainer people and never make any money, never learn how to do it. This open price, all part of these consecutive candles, okay, that open price is the change in the state of delivery. That means the algorithm sees these three candles and goes right to that opening price. What makes these three candles the order block is because we have a fair value gap down here. The momentum is shifted higher. This should stay open, trades down and touches the top of it, and starts to move higher away from it. It does so, okay? When this candle's open price, when that is breached, that validates this order block. Think about what I taught you yesterday in the live stream, how my entry mechanism was for the initial entry in 6 contracts short on NQ. The same logic is being shown here, just reversing it. Now, look at that opening price through all of this back and forth price action. See that? when you have this opening price, you want to extend that to the right and then study how price respects and deals with it. The wicks are always allowed to do the damage, but look what the bodies are doing. The bodies are staying in the upper half of the bodies. The bodies tell you the narrative. Okay, so if you take that range and do it like this, let me make it a little bit taller so you can see what I'm referring to. You're getting lessons on order blocks and didn't even ask for it today. Some of you asked for it, but that's not why I'm doing it. It's just I feel like teaching today. So we have the body on the open down to this close on the lowest down close candle. That range, okay, that range is where the narrative is going to be seen. You're gonna see what, if this is an order block, these things I'm going to show you right here, they're going to be present. Okay. Extend that forward. The body stops right there at that open. But what does the wick do? Trades down. This candle's an up close. It doesn't matter. It doesn't mean anything. This candle trades down into the open plus a tick or two and then trades higher. Then we trade down again. What is it doing? It sends the body into the upper half between that candle's open and this candle's close. That red line. Look at what's going on there. Where are the bodies of the candles? Any down move back into that range, where are the bodies? They're in the upper half. So you don't have to sweat picking the best entry. If you know what my order blocks are, and you really won't know everything about them until the books come out. When are you releasing the books, ICT? So the opening price, extend that through. You can see all the bodies are working inside that, but the wicks are allowed to do the damage, but they're never piercing the body's low. See that? And then over here, what time is that? 11:10. What do you think's happening right there? The algorithm that most people don't want to believe. It opens, it sends the price down into that opening price right there. We're cutting through candles, Sam. We're cutting through it, okay? There's no wipe off here. But that opening price, that's the sensitive price point, and that's the change in the state of delivery. Meaning that right there, any return to that price and or into the upper half of that consecutive down close candles, and I know some of this is going to be very confusing, especially if you're brand new. Because when we were talking about fair value gaps, you're like, I get this. This makes sense. But this is just for the folks that have been around for a while with me. And they've seen me talk about ICT order block. And they've talked about it in other circles where, it's this, he talks about this down close candle, but it's not always this one. But when he's using consecutive candles, what's the theory? It's the first time I taught this. My private mentorship students never seen this. Okay? Like I'm here to teach. If you don't want to learn, you don't need to be here. But you can't deny that right there and the time it's forming, Dave. Because it's all time. Time. So here is the first trade in delivery inside of the fair value gap. This is the PD array. At 1050, the algorithm will do what? It will seek inefficiency or liquidity. Okay, well, we have a gap. It could act as a breakaway gap. We expect it to trade down into it, but not fill the gap in. Wonderful. What time is that actually occurring? At 1052. Does it meet the criteria for a macro? Yes. So the time this is forming, it meets it. So that means the market should start to gravitate where? To liquidity, here, and where I took you to the daily chart. Because if the market's going to move, it's going to move to something on the daily chart. It's not just 1 minute charts. There's got to be some kind of higher time frame premise. Then if you build that in relationship to what you see on the smaller time frames, you have the best of both worlds. But the inefficiencies on the daily chart or the stops or liquidity that's being either engineered or engaged, traded to, booked to on the daily chart, all of the things that make the world go round in the financial market, the key premise and levels are going to derive from a daily chart. It's the previous day's high and low, the previous day's high and low in the last 3 days, last week's high and low, the upper quadrant, the midpoint, and the lower quadrant of that range. Those are always the levels that you need to have, and that is not classic support and resistance. Okay, these are reference points that the algorithm will always go back to.